Everybody. I'm going to
Thanks.
start here with the presentation tonight. I don't want to take up too much of your time, so I'm looking at about 40 minutes roughly for the presentation, but and saving some time for the Q&A, of course. But the bottom line here with this 2024 tax planning, and so we don't end up getting into this this little screen here where the IRS is basically taking everything that we have, is that we're coming up on our tax freedom day. And I want you to think about just how much you've worked so far this year. So whatever days you were working in January, whatever days in February, we're more than halfway through March, and we're still not quite there to April 16th. And that's our day, coincidentally, right around tax day this year, that all of us, if we're the average person, are going to be free of taxes. So you think about the 3 months plus the half of the month of April that we're basically working for the government to pay our income taxes and our sales and property and all these other taxes that we have. And how little the average person does any sort of planning when it comes to taxes, knowing that each day that we get this down, so that instead of April 16th, maybe this is April 1st, or maybe this is sometime in March, that we keep taking it down, that at that point, I mean, all of this tax savings can be used for how you see fit, how your business sees fit, how your family sees fit, and not how the government sees fit. And I can't stress that enough, that you have the option and certainly the choices, at least when it comes to 2024 taxes, to be able to create a tax plan that's going to work for you and your family, no matter who you are or what you have. Whether you have investments, or whether you have a business or several businesses, and whether they're small businesses or big, and whether they're C corps or S corps, you have a whole lot of opportunities to do the tax planning. And that, of course, is for 2024, either looking backwards, to the prior tax day, which actually was yesterday for a lot of the business returns. We had a March 15th deadline. So we could have got that extended. Actually, that was Friday, now that I think about it. But anyways, very recently, as far as the tax deadline, and of course, we're less than a month away from the April 15th, 2024 deadline. But there's really not a whole lot that we can do as far as 2023 tax planning. And really, what I'm going to be looking at here are just two different strategies that you go, and let's say that you've gotten a draft return done and you don't like the results. You end up owing a lot more money than you thought. Maybe your refund is a lot smaller than what you were hoping for. But whatever way it is, there's really not a lot you can do as far as 2023 planning. Now, we still have until April 15th of this year, so again, about whatever, 3 weeks or so, to contribute to an IRA. And you can see these amounts for 2023. So if you're age 50 or under, you've got the $6,500 limit. You can go up to 7,500 if you're over age 50. So it's a little catch-up provision. And this could potentially help us in two ways. One, if you haven't made any of these contributions, they may be tax deductible. And so it's possible to make a contribution to an IRA and claim a tax deduction for it. That's assuming that it's a traditional IRA and not a Roth plan. And so that's one possibility. The other one is, even if it is a Roth plan, or let's say you can't deduct it so that it won't have any impact on the 2023 taxes, at least if you didn't make that contribution, you can make it today, make it designated for 2023, and then you'll have the opportunity, if you want later this year, to do the same thing with a 2024 contribution. The other thing you can look at here is a SEP plan. And this allows you to go to the due date of the return, including extensions. Now, the $66,000 max is what it was for 2023. I'll have a slide up here in a little while for what it goes up to in 2024, with all of the plans kind of going up a little bit, at least as far as the contributions go. But this is something that I think a lot of people don't understand or recognize, is that if you do have a liability and you didn't contribute to a SEP or a 401k, or maybe you didn't contribute the maximum to it, you have now until the due date of the return. And if it's a business return, by extending it last week, it now pushes us back into September as far as when that return is due. So it gives us time to figure out what is our tax liability for this year, and is there, this year meaning 2023, and is there anything we can do to reduce it? And again, very, very few options here, but this SEP plan or this possible IRA is one of these options. Now, the contributing to the 401k plan, not including extension, so it's due date of the return. So you may be able to do that up to April 15th, but not later to that. Understand, though, that a prior law that said you had to establish it by the end of the year for it to be valid for a deduction for that year has been eliminated. So you can establish under this Secure Act, this 2.0 Act here, to the due date of the return. And so as long as your due date of the return wasn't this past March 15th, you have this available to you. The late plans, though, cannot include the employee contribution, just the employer. And that's because the salaries that are associated with the employee contribution, those end as of December 31st. And so we need to match up the year of the employee contribution with the salary, meaning it can't go past December 31st, but the employer contribution can. And the third thing I want to talk about, not the IRAs, the SEPs, like the first slide, or the 401s, like the last slide, is the HSAs. And these are so incredibly tax favored. So what is an HSA? Well, health savings account is what the HSA stands for. And it allows us to make contributions up to tax day, so up to April 15th of this year, for last year. Now, these are high deductible plans. So these are high deductible insurance plans. Doesn't mean cheap plans. It could be several thousand, tens of thousands of dollars in premiums and still be a high deductible plan. And if that's the case, notice here that if you're single, you get this $3,800 contribution, and almost $7,800 if you're married filing joint, as far as what you can contribute. Over age 55 can add an extra grand to these amounts. What does it mean, though, and why do I have such a fond tax planning affinity for these types of plans? Is that the HSA is triple tax favored, where almost any other plan you can come up with is going to be double tax favored. So if we take the Roth IRA, let's say, that's a double tax favored plan, in the sense that you get the money, let's say you get some wages from your W-2 job, and you then pay taxes on it. So you don't get any tax break there, but then when you contribute to the Roth plan, it grows tax deferred, and when you take it out, it's tax free. So the tax deferred growth plus the tax free distributions make it double tax favored. What makes then the HSA one better here? What makes the HSA a triple tax advantage? And that is, number one, when you contribute the amount. So let's say that I'm married and I'm over age 55. So I could contribute a maximum of $8,750 for last year. And I can do that now, at least up to April 15th. By contributing that $8,750, I get a tax deduction for it. So I'm going to save something, whatever my tax bracket is, somewhere between 10 and 37%, plus the state taxes on that almost $9,000 of contributions. Now, in addition, that grows tax deferred. meaning that you put that in a mutual fund, you put it in the stock market, you self-direct it through a self-directed custodian. All the dollars that that plan earns while it's growing is tax deferred. So if you put that $9,000 in, and let's say next year you somehow double that, so now we have $18,000 in the account, that $9,000 of growth is tax deferred. And then we go to the final part of it, the third part, and that is when the money is withdrawn and used for medical expenses. And that's a pretty big list of what these medical expenses can be. Those dollars are tax free. So as long as you claim the deduction, you get the tax deferral, and when you pull it out, you're using it for medical expense related payments. This is a triple tax advantage and one that I strongly recommend. But the problem here is that we've kind of reached an impasse as far as what 2023 is going to permit. And so we really need to start looking at 2024. And so I'm going to have a slide up here with the 2024 differences between 2023. But if you are looking to contribute to a retirement plan and beat the deadline to gain that tax deduction, this is where we're going to be looking at as far as what we can put in maximum wise. And these contribution amounts that you see, these maximums is 66 grand or what have you, and that's going to be the same for the SEP typically. The 66,000, that's the maximum per person. So it's not per job or per business or whatever, it's per person. And so again, make sure you're aware of what the maximums are and see, does that really help you out? Because here's an example of just something that I want you to take a look at just to consider. And that is that this person comes in, single individual, has a high AGI, has some charitable donations and taxes and maybe some medical expenses and mortgage interest and what have you. And so she takes off this $50,000, comes up with this taxable income of 250K, and now is looking at almost a 30% tax bill. And of course, I don't know what amounts were withheld out of wages or anything else, but the payments for the years are going to be $72,000. Not happy with this, the taxpayer then says, well, what if I make a SEP contribution and I make a $50,000 SEP contribution? Well, everything else is the same. The itemized deductions are going to stay the same in this hypothetical, and we just bump up our deductions by 50,000. So instead of our taxable income being 250K, it's now 200K. And look what that does to our tax brackets. Not only does it drop our bracket down, but it also reduces our effective federal tax rate. And so we're getting this huge return on our $50,000, saving almost $20,000 in taxes, just even if we put this money into a money market or some very low interest yielding account. So I'm not assuming that we're making any money on our SEP contribution, but our tax savings here can be massive when you look at the feds in the state as far as what the income is. One other point I want to mention here, and this is something that the IRS is going to be looking at a whole lot more. They've already announced several projects on cryptocurrency transactions, and so audits are going to be going up in this area. But you have to be able to answer this. I mean, you have to answer this question one way or the other. In that, are you using crypto in any way to either dispose of some sort of a financial interest in the currency, in a virtual currency? And you have to check the yes or the no box. Understand what that means if you check the yes box, that what you're saying here is that you're engaging in some sort of cryptocurrency transactions that are reportable as a taxable or a potential taxable event. So here's an example of somebody who, let's say in my law practice, I gave you a legal bill and it just happened to be this 37,294. First of all, I hope you got good services because that's a pretty hefty bill. But anyways, you pay me in one Bitcoin. And this was what the value on June 1st. If we go a couple years out then, and let's say I'm still holding that one Bitcoin, what are my tax obligations? Well, if I sell it for the value on this date, March 1st of 2023, I'm incurring a capital gain of $1,456. This amount is taxable to me as a capital gain, just like if I would have bought Microsoft stock or Apple stock or whatever and had a capital gain of $1,400. Taxed in the same way, holding period more than a year and a day, so it's long term. So this is taxable. The other part of this transaction is that this $37,200, $294, is taxable as gross income to my business. In my case, a law practice, if it's maybe an architecture or engineering firm, maybe it's some other big business that's receiving 37 grand in gross receipts. So we have two taxable events here. One in 2021, when I get the money for the services rendered or the goods, whatever. And two in 2023, when I sell the Bitcoin and I have, in this case, a capital gain. Now, when we're looking at this, remember here that if we go forward with this, and let's say on that particular date that I did the legal work, I get the one Bitcoin and I immediately transfer it to cash into US dollars, I don't have to worry about the capital gain. There is none. And it's the end of the transaction because when I put that 37,294 on my register as gross receipts, it's income, just like any other income. If I keep the Bitcoin, that's the only time when it's different. So I recognize the gross receipts, which becomes my basis in the Bitcoin. And then when I sell it, I have a gain or a loss, depending on whether it's higher or lower than my basis in the Bitcoin. So, anyways, those are some of the thoughts I have for the 2023 tax returns, and maybe some of the planning that you can do as far as the 2023 taxes. But I really think now that once you go forward and you look at those different options, you're going to be looking at the 2024 taxes. I mean, obviously, if you can contribute to the SEP or 401k or an HSA or IRA or all these other different acronyms, great. But you really need to be planning for 2024. And the first thing that you need to look at, what I look at when anytime I'm doing tax planning for anybody, is who are you? What types of hats are you wearing here? Because you could be many different, I guess, wearers of different hats, depending on just what you have going on in your life. So, are you an employee and getting a W-2? And if that's the end of the discussion, your tax planning is going to be very, very limited because the only deductions you're going to get to reduce this are going to be your Schedule A itemized deductions. And I'll show you why that can be difficult in a few minutes here. Whereas if you wear one or more hats of these bullet points, so you're a small business owner and you have a C Corp, or you have a S Corp up here, or a Schedule C or some other flow through entity that's going to get you a K1, or you have real estate, whether you're an investor or professional, whether you invest in the stock market or you're a professional trader in the stock market, or you're a farmer, or you have 1099-Rs for retirement income. I think you can see that, I own a C Corp and I take a small salary out of it. And I also own an S Corp, and I have an LLC that owns one rental property. And so I may wear many hats. And the more hats you wear here, the better your opportunity for tax planning, because the more credits come into play and the more tax deductions come into play. And here's why, if I go back for just a quick second, when I say, if you're an employee and you're stopping here with your W-2, the only deductions you're going to get are your Schedule A. Well, in order for your Schedule A deductions to make sense, look at where we are for 2024. And that means that if you're married and you file a joint return, you've got to have more than $29,200 of interest in your mortgage on your personal residence, plus your charitable donations, plus a maximum of $10,000 of state and local taxes. And so a lot of times, let's say you have 10,000 of taxes and maybe 10,000 of mortgage interest or whatever it happens to be. When you add it all up, you may not exceed this 29,200, and so therefore you're going to take the standard deduction. And likewise, if you're single, it's half of that. So you have to add up all of these different deductions that you have and see, is it more than 29.2? If yes, let's say it adds up to 40 or 50,000, you'll take the bigger amount. But if it adds up to a smaller amount, you get the 29,200. So you may not have many deductions at all there. And when I've been reviewing returns, and I've been doing this since, I guess now 30 years now since I've left the IRS, we see so many missed tax deductions over the years. I don't want to claim the home office if I have a business, even if I qualify for it because they're going to audit me. No, if you qualify for it, claim it. Points with my home mortgage. Well, I didn't know I could deduct that. I don't know what tax credits are available. Maybe energy efficient home improvements or automobiles, EVs, or there's a lot of different tax credits that come into play for individuals and business owners. So make sure you're aware of what those are. Tuition deductions for college expenses or other higher education expenses, even though these have income limitations, so there's certain phase outs involved. This is a huge amount of money for somebody that can qualify. And then, of course, the people that own businesses or rental properties and don't understand all the deductions that they can qualify for. There are so many rental property deductions, both out of pocket and depreciation and other types of expenses that are not cash flow related expenses. And the same thing with your self-employed businesses. And when I say self-employed, I'm not just talking about a sole proprietorship that files a Schedule C. I'm talking about, let's say, myself who owns a law firm and has it set up as an S corp. Am I claiming all of the tax deductions that S corp is entitled to, or the LLC? Am I claiming all those deductions? If I have gambling winnings, am I claiming the losses or any losses to offset that? And then retirement plans. Am I maximizing the contributions and minimizing the taxes on any distributions? And with real estate investors, it's amazing to me how many are going to be so sorely disappointed when they go to take different tax deductions, including this qualified business income. So we get this QBI, and I'm sort of scratching this out. So it's going to look like I'm writing like a kindergartner on the board, which in effect I'm doing. But QBI, qualified business income, if you can satisfy these three requirements, so you're keeping accurate records contemporaneously, keep them separate for each of your rental properties, which you should be doing this anyways. And you've got a time log that shows that you're spending at least 250 hours a year, so 5 hours or more a week, roughly, on your rental enterprise, and you qualify for a potential 20% tax deduction. But are you actually making that election on your tax return? And if you are, do you have these books and records and your time logs and what have you to describe all the services that have been performed and who performed them and when and what was done? Can you back this up if you happen to be one of the lucky few that gets an IRS audit? So I put this in here because you're going to see, and I'm seeing a lot more IRS audits on real estate investors simply because they don't have the documentation to back up their deductions and maybe not even to back up their time, this 250 hours or more on all the rentals to qualify for this QBI. So again, make sure that you're not one of those guys that gets audited and can't take the deduction or basically has it added back into income simply because you don't have the documentation, that you don't have the proper record keeping. All right. Let's look now at some income shifting opportunities. The gifting this year went up $1,000, and so we're too late to make any gifts retroactive to last year, but we can give up to $18,000 per person per year. So a married couple, in effect, can double that to 36K per year. The estate tax exclusion, we're done with 2023, is a little bit over 13 million, 13 and a half million. So a married couple with proper estate planning can double this and get us over $27 million before any estate tax would be due. And so obviously very, very favorable. Not a lot of people have these kind of assets or these kind of valuations, with one major caveat here. And that is that this is what it is for 2024. 2025 is going to go up as well. The question mark comes in 2026. What is that going to be when the Trump tax laws sunset? And so these numbers are going to go way down. They're going to be cut in half or more, depending on who's in Congress in, I guess, 2025 to make the laws for effective 2026. So don't look at these numbers as being super high, especially if your assets, let's say, are, something considerably lower. Let's say that I'm worth 3 or 4 million on paper, so I don't have to worry about the estate taxes. Oh, yes, I do, because we don't know what 2026 is going to bring, and we don't know what our value of our assets is going to be. So our assets go up in value while the estate tax exclusion goes down, and that can make a recipe for estate taxes that we may not have today. So look at this gifting, because it's a really nice opportunity for us to be able to transfer assets. Now, I mentioned before that I was going to show you a slide that had the contribution amounts between 2023 and how much they go up for 2024. So this is our 2024 column. I filled in a couple of the miscellaneous ones here where we know that this TBD is now 18,000 and this is a little bit over 13 million. But you can see that these numbers go up, and you could expect something very similar to next year. So for the 2025 column that's going to be here, you can expect the SEPs and the 401s and the plans or what have you are going to go from 69,000 up into the 72 or 74,000 range. But this just gives you some opportunities to look at what we can do with some of the tax planning between 2023, 2024, and future years. Now, when we give money, so a lot of times if we're looking at, well, what happens if I give stock that's gone up in value, or if I give cash to my kids and they earn money, be aware that this kiddie tax on unearned investment income, once it hits $2,600, the kids are taxed at the parents' rate. So a lot of times we look for investments with the kids that is not going to generate taxable income. So maybe it's municipal bonds, maybe it's a stock that is not paying a dividend, something along those lines, or something that's going to defer the taxation into future years so that we don't get hit with any of this kiddie tax. But the gifting itself, we can do that for 2024, obviously today or anytime before the end of the year. And we're planning for this year and the future. And while these gifts may be limited in the sense that if we give more than this 18,000, we as the person who makes the gift has to file a gift tax return. There's an unlimited amount if it's medical expenses or qualified tuition. So we have these opportunities as a get around. But I think, one of the real big benefits of this is that it removes the asset from your estate along with the appreciation on that asset. So when we look at the estate tax and it's 13 and a half million or whatever, and more than 27 million as a couple, for a lot of us, we don't have to really worry about that. But what if that number goes down? Or what if we do have to worry about it? Good position to be in, right? In the sense that you have a lot of assets relative to the average person. But here, let's say that we take our Google stock and we give away a market value of $18,000 to one of our kids. Well, we've removed $18,000 from our estate, okay, which is good estate planning. But now what happens in the future if that Google stock goes from 18,000 to 180,000? Over time, it goes up 10 times in value. We've also removed that appreciation from our estate and thrown that into an estate of somebody who is presumably much younger and much less wealthy. So the gifting, I think, is a real valuable way of looking at it as a proactive tax planning approach to not only income tax, because any of the dividends or interest or anything that asset distributes in the future is going to be taxed on the kids and not at you. So very proactive approach to certainly a potential reduction in a couple years of the estate tax exclusion. So it's intra-family tax planning, where a lot of times you'll hear tax planning persons like myself talk about intra-entity planning. Well, let's have a C corp, let's have an S corp, let's have an LLC. Let's figure out how they all play with each other here tax wise. Well, this is ways that we can look at using our kids or maybe grandkids or going up the food chain, parents, grandparents, stuff like that, where we can use gifting to be able to work some really nice magic with our overall tax plan. We also want to look at required minimum distributions. So this applies to anybody this year that is going to be age 73 or greater. These required minimum distributions certainly could affect your taxes by increasing your taxable income. Also, your Medicare costs could go up, and not understanding these RMDs could result in penalties if you don't take enough out. Now, for 2024, we have a qualified charitable distribution. It went up 5% from last year. So now you can distribute $105,000 immediately to charity, and that may be way more than what your RMDs are for the rest of the year, and do that in charity to not have this bullet point 3 impact you. So we might not affect your personal taxes. The Roth plans have never had RMDs, but the 401k Roths did in prior years. In 2024, that's been eliminated. So even the 401k Roth plans, we don't now have to worry about RMDs. Again, that's for just those that are over age 73. Question I get all the time is, what about paying my kids and my business, and how does that work? Well, these are the maximum amounts that anyone can receive in 1 year. So you can see it goes up a grand or so, $800, $900, whatever, every year. So that in 2024, assuming your kids don't have any other income, you can pay them up to this 14,600 amount on a tax-free basis. Now, don't pay them 14,600. Why? Because any of the pay that you have has to be reasonable. And I can't emphasize this enough, that if you get audited, you have to show, well, how much time did the employee spend? In this case, your kid. So how many hours? What kind of effort was it? In other words, what were they doing? How old are they? And what are their abilities, both physical and mental, to be able to do the work? Because if we look at this next example here, where we have a small business, and so this business was a client of mine a while ago that was in some sort of doll collecting or what have you. But anyways, she had about 125K of income come in, and her cost of goods sold, that's what this COGS stands for, and other expenses was 35,000. So if you subtract this amount from the 125, you can see that she has a net profit of 90,000 and had an approximate tax rate of 30%. So that included some income, self-employment, and what have you. So she wants now to pay her kids. So she has two kids that can do actual legitimate work in the business. And so assuming that this is reality, okay, that our 15 and 17-year-old really did work 15 or 25 hours, that 10 or 12 bucks an hour is a reasonable wage, and they did it for 40 weeks a year. We have $18,000 of wages now that will not be taxed on these kids' returns. Again, assuming that they don't have other income. And that 18,000 then becomes another tax deduction here. Now, there would be other taxes potentially due to for this business to pay, and there would be more deductions. But just to keep this simple, I'm just keeping the expenses exactly the same, but we have 18,000 more of deductions, which is now going to save us as a family about $5,400 in tax. So this is our intra-family tax planning that we can look at by incorporating kids into our business. And the tax burden there on employment taxes and what have you will depend on the type of business you set up. But it is something that I think all businesses need to look at. And if you don't have a business, to me, it's really the best tax shelter that anybody can have in the United States. I think looking at your home personal residence there, probably the biggest one for the average American because of the tax breaks when you sell and the potential tax breaks on interest and taxes while you own it. But when we're looking at other tax shelters, legal ways that we can avoid taxes, starting a business in 2024, if you don't have one already, has to be number one. Acquiring rental properties. I love rental properties and real estate for taxes, assuming you can find a good investment, and that's up to you and your due diligence. I love the tax benefits that rental real estate, either commercial or residential, can produce. Once you look at the businesses, understand your choices between this really nice flat tax for a C corp. If you're in the 30 some percent bracket, certainly a 21% rate is very attractive. Whereas if you've got a flow through entity, getting a 20% tax deduction, very, very attractive as well. So getting that tax plan in place now, keeping the records and getting a tax professional in place early, to me is absolutely critical as far as what exactly are you expecting from your business or your investments, and using a tax pro to figure out how best to get there. And this is something that I'm surprised that a lot of business owners and even people that are making a very nice income have no idea how to reduce their overall taxes. So we're going to make sure that we claim all the tax deductions available. We're not holding back any so that you can pull it out of the hat in an audit. Nope, we're going to claim everything. We're going to understand the record keeping and the rules for our cars, for our meals, and for travel, and understand how we can deduct some expenses that are often personal. So yeah, you ask the IRS if you're going to deduct your electric payment, they're going to say no. And the IRS would be right. You can't deduct your electric payment, but your business can. And so whether you have a home office or really what I like, this fourth bullet point, this accountable plan where the business reimburses you for a lot of these expenses, home office for equipment, furniture, cell phone, computer, all of that stuff, understand what you can deduct. And then understand the credits available. So whether it's these economic stimulus type things that we're going to see them again in the future, we saw them for COVID, and we're going to have more stimulus plans coming at some point. Enact and when those are enacted, understand what you can do. Understand your entity choices for any businesses or investments, and have this coordinated. So don't do it in a vacuum here. That we want to make sure that all of your investments and all of your businesses are properly tuned for taxes so that you end up paying the least amount possible. Right. Just a couple few other ones before I wrap it up here for this evening. Meals, 50%. And so that applied to last year and the year before. So that's our restaurant type meals, takeout, whatever, using for business meetings while you're on the road. Traveling includes beverages, not lavish or extravagant. So basically, just be reasonable. And that's the word that I use over and over all the time. Reasonableness will get you a real long ways when it comes to not only what you should and can deduct, but what you can support if you happen to get your return, business or personal, audited by the IRS or by the state. Okay, a couple of last things here. You notice we've got some inflation adjustments this year for the ability to deduct all of your computer equipment or what have you as a small business. The 6,000 pound vehicle amount went up to a little bit more than 30 grand, 20 grand for a regular automobile, used 100% for business, and bonus depreciation, 60%. Now, one caveat to this is that the House has already passed a bill that would allow the 60% amount to be 100%. That's stalled in the Senate. And the last thing I checked today before the presentation to see what was going on with this, Senate says they'll take it up by tax day, but there's not a lot of hope that it's going to pass as is. So who knows? It's 60% until Congress says something different. The other thing with the tax planning here is the timing. And you need to decide when you're going to claim income as taxable. So are you going to delay taking your Social Security, or are you going to take it this year and bring it into play for taxes? Are you going to sell a piece of real estate in full? Or are you going to do an owner carry and do an installment sale or a like kind exchange? Are you going to be using a Roth IRA or a traditional IRA? Because the Roth IRA says you're going to claim that income as taxable today, but in the future, it's not going to be taxable. Or if you've got taxable investments, well, there's nothing that says you can't use tax favored investments today. Not only real estate to get the tax deductions currently, but oil and gas investments typically very favored, municipal bonds, maybe these op zones, which are not quite as prevalent as they were several years ago. But other ways, how can we defer income with an IRA or with an annuity or with various retirement plans, whether they be defined benefit or defined contribution, as I've been talking about here tonight. So a few last minute thoughts here, and then I'll turn it back over to my good buddy Kendall. And I think this is what I would like to leave you with. Number one is that don't file a return unless you understand it. So if there's numbers on the return that you don't get, this $10,000, where'd it come from? Or I thought it was going to be 20 grand, or I thought it was going to be 300, or I didn't think about this at all. Double check the return, and ask questions. The tax preparers make mistakes. I mean, this was a horrible time for me until, like I was telling Kendall a little bit before we came on tonight. It's been about 10 years now since I had a firm that was preparing returns, and I never saw the light of day at this time. And so mistakes can get made. So make sure you understand the return before you agree that it's okay to file. If you don't have time, it's perfectly cool to file an extension. File the return though, even if you can't pay. So if you're going to file an extension, make sure that you file an estimated payment, because the extension to file does not extend the time to pay. So if you end up owing money, you're going to get a penalty for paying late. So again, why am I saying this bullet point? File even if you can't pay, because we want to start the 3-year audit statute of limitations. We want to get that clock going. And if you make mistakes, you can always amend it to file a correct return. And finally, look at, if you're married, don't assume that married filing joint is going to produce a less tax result, less taxes due than filing separate. Married filing separate does not mean you're going through a divorce or you've got anything wrong with your marriage. It just means that filing as two individual taxpayers rather than as one jointly produced a better tax result. And so you've got this option to make this decision as to how you want to file. And so I'm going to leave you here with this little quote from William Buckley here, and I agree with him. Yes, anyone that wants to talk about fairness and taxes, we got the wrong subject matter. So let's not even go there with fairness. Let's look at how can you take your picture and incorporate your businesses and your investments and your wages and any other sources of income and pay the least amount of tax as possible. So with that, I'm going to turn it back over to Kendall. And thank you very
You're awesome.
much for listening, everybody.
You're so amazing, Scott. I appreciate it so much. It's sage advice. And, some of it, a lot of people just think is, oh, there's so much complex detail, and there really is in taxes. But some of it's just wise information, like, just plan, make sure it's reasonable, and you can file extensions. You're not going to jail unless you're trying to be fraudulent. So just, be reasonable about it. Very cool. Thank you, Scott. So we did have a lot of questions come in. I had a lot of you hold off until right now for the Q&A, just because a lot of the questions actually did get answered throughout. So if the question was not answered yet, let's go ahead and open it up. And Scott, I guess as far as rules for Q&A, because we always have lots of questions, be as succinct as possible. And so when you submit a follow-up question, it does not tie to your first question. So we don't see it tied. So please try to include that in one question and be succinct as possible. And I guess that's more of a general question, not too specific about your aunt's dog's brother-in-law, right?
Yeah, I think that's fair, and keep it to the topics that we talked about here this evening. Is there's through all the years of doing this that there's millions of tax questions and millions of tax answers. But
Yep.
anyways, yeah, let's go ahead. Let's grab a couple of these here. And again, I want to be very cognizant of everybody's time here as we're at the
Especially
one
your time.
hour thing here. So keep it to maybe a 10-minute Q&A session or 15
Great.
minutes, and
I'm great
we'll
with
take
that.
it
Let's
from
do
there.
15 minutes. Scott, do you want me
Okay.
to take the questions, or do you want to read them and just go? Whatever's easier for you.
You know what? I can take a look at the questions here, and if you want
Okay,
to type the answers to some of them here that we've
great.
already answered. But the first question is anonymous here, and said, did he say deductible meals have to come from a restaurant? No, they don't have to come from a restaurant. So if you have clients coming to your office and you're buying here in this case a fruit and vegetable platter at a grocery store, is that deductible? The answer is yes. So we don't have to worry about that. Good question here. Let's see. Can a parent gift up to $18,000 to a child without the child paying taxes on the money gifted to them? This is always confusing to people. But the rules with gifting, number one is that the person who receives the gift never pays taxes on that gift, right? So if everybody on this call tonight wants to gift me $18,000, I will take it, right? And I don't pay tax on any of that. The problem, though, well, there's several problems. One is that the person who makes the gift does not get a tax deduction. Okay, so it's a tax neutral event. I gift Kendall 18 grand, I get no deduction, but Kendall doesn't have to pay tax on that 18,000. Now, if Kendall takes that 18 grand and puts it into, let's say, puts it into the stock market and makes $1,000, Kendall has to pay tax on that $1,000, but not on the 18 grand. And so I think that's really important. Really good question there. Let's see. Can I have my self-directed solo 401 custodian take my RMD amount, send it directly to a 501c3, and therefore the amount becomes a non-taxable event? Yeah, the answer to that is yes, you can. And so if you're required to take required minimum distributions, so again, this won't apply to a Roth account, but if you have a retirement plan where RMDs are required, then this year you've got that 105,000 maximum that you can contribute to that plan. Okay, so
Wow.
we're good there. Another nice question here. Um, let's see. Can a 401k required minimum distribution be used to contribute to a IRA? Yes, it could. I mean, you could take that out, the RMD out of there. It's taxable to you. unless it's a Roth. And then as long as you have earned income. Okay, so that's the key with an IRA or any of these retirement plans is you've got to have wages or something that's subject to self-employment or employment taxes. Okay, let's see, how far back can you file an amendment? To get a refund, you can go back 3 years. So file from 3 years from the date it was due. There's rules that 2 years from the date you made the tax payment, whichever is later. But again, if you think you need to amend a return to get a refund, file it as soon as possible. Let's see, I have a single member LLC, not real estate protection set up. Any comments if it's too late to do that? Or whatever, I want to sell in the next 4 to 6 months and still do a 1031. Okay, so this person is basically asking, it's like, I've got this LLC for my rental property. If I want to do a 1031 exchange, you have to make sure that the LLC is on both sides of the 1031, meaning that you have this relinquished property and whatever your replacement property is also has to be owned by the LLC. I think what you want to do with that LLC is look to see how it's coordinated with any other assets that you own and where are the likely sources of a lawsuit. And so this is where I think when I mentioned, and Kendall mentions this a lot, and so does Don when Don hosts these events, is that there is not a one size fits all asset protection or tax planning approach. There just isn't. And when we're doing these events live and we've got this big audience, it's real easy to point that out that there's 300 of you out there in the audience and we have 300 different asset protection plans. And so the same thing with this question that Michael asked is, who knows what your asset protection plan should look like, but it's not too late to set it up. And in fact, I think the longer you wait, the more risk you're ultimately taking, because whatever exposure you might have, whether it's higher taxes or in this case, more asset protection exposure in the event of a lawsuit, why take that risk? So if you've got something to clean up with asset protection, let's do it now. Be my advice on that one. All right. What Chelsea's asking, what should I do to find a knowledgeable tax accountant? I think what I would be looking at is I like licensing to begin with. So that an attorney, a CPA, or an enrolled agent, we all have licensing boards. And so if we do something wrong, you have recourse against our license or potentially malpractice. But I think the most important thing is getting somebody that prepares returns that are similar to yours. So when I was preparing returns, I did a whole lot of small business owners and real estate investors. I did not do a lot of farming returns. So if you were a farmer or whatever, I wouldn't have been a good person to have do your return. Doesn't mean that I wasn't a good preparer. It just means I wasn't good for you. So ask a lot of questions and see if they prepare returns that are similar to you. Okay, next one here is asking, if you have an LLC and you want to hire your kids, must they be paid via W-2 or can it be by check? And does the kid have to file the return on that? Yes, it has to be by W-2. So the advice I have whenever you're hiring a family member is treat that family member exactly like you would treat somebody who wasn't. All right. So if I'm going to hire my kids here, I may say, well, it doesn't really matter. I don't care about this. It's all in the family or whatever. No. So treat this as something like, let's say that I'm going to hire Kendall's daughter, okay, to work for my business. And so what am I going to want to get from Kendall's daughter? Well, I have to get her personal information and her social security number, and I'm going to pay her by W-2. And if the law says I have to withhold taxes, I will. And if the law says I don't, then I won't. But I'm going to treat my kids just like I would treat any other non-related employee. Okay, so W-2 it for sure as far as your kids go. All right. Let's see. Anonymous here for an S corp. Can the S corp open a SEP IRA for the employee? Yes. Any entity can open up a SEP or any of these retirement plans that I mentioned, and you don't even have to have an entity. You can do it with a sole proprietorship. Okay, Mark is asking here, can you speak more as to what business activities make somebody a real estate professional? One of the things I would recommend here is go to the Protect Wealth, and Kendall, you might be able to comment about this because we've done real estate professional webinars that we've spent an entire 40 minutes or so discussing these. And I would say go to those webinars because you need to accumulate at least that 750 hours and more than half of your personal business time. Okay, so if you're working 1,000 hours in some business that's not related to real estate, you need to have at least 1,001 hours in real estate itself. And so whether that's brokerage activities or showing properties or doing repairs or all of this stuff, there's a lot more information than I can possibly give by answering this in full.
Yeah, and Scott, I did put the link to our YouTube channel in the chat. So you can actually click on that, everybody. Click on the chat. And I would suggest, honestly, subscribing to our channel will be the best, really, truly, because then you'll be at least notified. Well, as long as you hit notifications, you'll be notified when a new video is posted. If you go to that channel, you can also see a search for some Scott Estill previous videos and some real estate videos Scott did with us, real estate taxes specifically. So we have covered that in the past. That should be down there in the channel. Thanks, Scott.
Yeah, and I'd strongly recommend that, Kendall. I'd recommend that to anybody that's attending or listening to this even tonight or in the future, is that there's so much information available out there that I love it. I love it because I learned so much stuff, about different types of investments or different asset protection strategies that maybe I didn't think of or that I'm not, considering for just a certain specific situation. So I learned quite a bit from that as well. Can we do just a couple more questions here? Can I take up just a
Yeah.
few more minutes? Because there's a ton of questions here, and I apologize as far as not being able to get to a lot of
We do
these.
our best to get to them, guys. Yeah, there's been over 400 people on the call tonight, and so a lot of questions. Unfortunately, we won't get to them all, but we're going to do our best to get a few more. Go ahead and pick a few more, Scott. Maybe I don't know, 5 minutes, 10 minutes or so, whatever you
Okay,
have time. You've been so gracious with us. I appreciate it.
be glad to. This is another anonymous says how many years can you address in an audit? So how far back can the IRS go? This is why I want to file tax returns, because let's say that I have forgotten to file tax returns since the year 2000, just sort of slipped my mind for the last 23 years. The IRS can go back and audit 2001 all the way through. There is no statute of limitations until you file the return. Once you file the return, then we have a 3-year statute, unless you commit tax fraud, in which case there is no statute of limitations. And so if I committed tax fraud in 2005 and the IRS can prove it, well, then they can still audit that year. But realistically, we're looking at a 3-year statute of limitations, so that the IRS right now is auditing returns from 2021 and 2022, and they'll start auditing 2023 returns maybe later this year or early next year. So yeah, very, very good questions. Let's see. I created a Wyoming LLC as a partnership. I live in Illinois. How will this be taxed? Can we choose to have it disregarded? Well, when you're looking at a taxation issue, you have to decide how many members you have in this LLC. And by your question here, you're saying that we have a partnership, which tells me that we have 2 or more members in that particular LLC. And the only time that you could disregard it would be as if it's a husband-wife partnership. So if it's, let's say, Kendall and I setting up that Wyoming LLC, and whatever, Kendall and I both live in Illinois, as this question says, we could not disregard this entity. We could have it taxed as a partnership, or we could have it taxed as an S corp, or we could have it taxed as a C corp, and that would be up to Kendall and I to decide how we want it to be taxed. And again, Kendall and I would have to sit down with tax planners to see. Kendall may want it as a S corp, and I may want it as a C corp, or maybe we both want it as a flow through, and we need to consult with a asset protection attorney to see, is it okay to leave this as a partnership, or should we make it an S corp? And does it matter? Okay. Rogers is asking, how is the 20% QBI calculated? Is it on the gross or the net income? This is an easy one for me. It's taxed on the net income, not the gross. Let's see, what other ones? Any other ones that we see, Kendall, that I need to get? Some people are asking if this is being recorded, and it is. How do they get the recording of that or the links to that, Kendall?
Yeah. So again, honestly, go to YouTube because it will be there before the email is sent out tomorrow. So Zoom only allows us to send this out 24 hours after the webinar today. So that will come via email from Zoom. But if you actually go to YouTube and subscribe and get those notifications, literally you'll have it tomorrow morning sometime when it gets loaded. So that's probably the fastest way, but if not, you'll get an email.
Good, good. Okay, a couple more quickies here. Does the 50% meal deduction apply to both in-state meals and travel to out-of-state meals? The answer is yes on that. And so that definitely works out well. The issue on and I'll get to this one here, RMDs, how does contributions to charity impact taxes? That's a question that Linda gave, and that's a good question, because if you take the money out as taxable income to you and then deduct it as a charitable donation, you are limited to either 50% or 60% of your adjusted gross income to charity, depending on what you give. And also, it'll increase your overall adjusted gross income, okay, because the donation as a deduction applies to taxable but not adjusted gross. So therefore, you may owe more in other taxes as well. So if you're going to take an RMD out and give that money to charity, you're better off to forget taking the money yourself and having the RMD be directed directly to the charity and keep you out of the loop, at least as long as the amount is under that $105,000. All right. I think that might be a good place to stop. I'm not sure. Like I said, there's so many other questions here, and I apologize that I can't get to all of them, but we would be here, I guarantee you, for another couple hours, and nobody wants to listen to me or anyone else talk taxes for another couple hours. So, so with that, Kendall, I'm going to, thank you again for having me on here tonight, and thank the hundreds or the thousands of people that may eventually listen to this for looking at this as a way to take a proactive approach to your taxes, that you don't have to settle for paying a huge amount of tax if the law allows you to reduce it. And so, again, I hope all of you work with a tax professional to be able to accomplish some of these goals and get that tax bill down to the absolute legal minimum. So thank you again. Good night.
Thank you, Scott. Awesome. Yeah, there's a lot of questions still. I apologize if you still have questions. Honestly, I would suggest you, again, YouTube channel, but another one is come to our Asset Protection Summit if you have not yet. We usually put on, 3, 4, or 5 different advisors at any given time, literally answering questions all throughout the event. So if you have specific questions, next one's coming up on April 22nd. It's a live stream on Zoom. Jump on in. We'd love to have you. Scott, you've been a part of those many times, and we appreciate it so much tonight, Scott. Really good information, at least I'm amazed at how much you can actually do for 2023 and 2024. It's a big deal. Again, tax prep versus tax planning, thousands of dollars in difference. Don't wait until April 15th to tax plan, everybody. Scott, anything else before we wrap up?
No, I just, I wish everybody would take this challenge and go out sometime before, let's say, April 15th of this year, and get yourself in a situation where you've got a tax plan, or at least an appointment with somebody to
Yeah.
get a tax plan for 2024. Let's everybody at least make that
Ooh.
very late New Year's resolution for 2024.
Oh, that's a big goal that saves them a lot of money. I love that. Thank you so much, Scott. Really
Take care.
appreciate your expertise tonight. We wish you and your family well. Thank you so much, everybody, for being on. Watch for the recording, and we look forward to seeing you all again soon. Thanks, everybody. Good night.